Welcome to Tesla Deep Dives. The pivotal topic on our agenda today is the reality of driverless transport, assessing the viability of unsupervised FSD and dedicated Cybercab fleets. Driverless transport isn't a future vision, it's a current, high-stakes financial gamble. At the heart of this disruption are two competing forces: the promise of unsupervised full self-driving, FSD, and the dedicated Cybercab fleet. The market has priced in a revolution, with some analysts like Wedbush's Dan Ives projecting a future valuation that could reach $3 trillion. This entire thesis rests on moving from supervised driver assistance to fully autonomous revenue-generating services, a transition that is proving far more complex than initially promised. For years, the core technological battle has centered on data volume versus hardware redundancy. Tesla's approach, leveraging billions of miles of real-world driving data, led to its full self-driving, supervised system, which it claims has a collision frequency nearly 2 times better than human-driven vehicles in North America. In contrast, rivals like Waymo, which utilize a sensor-rich architecture, including LiDAR, have already logged over 22 million rider-only miles and report being involved in 84% fewer crashes with airbag deployment compared to human drivers. The two distinct technical paths create a fundamental schism in safety and scalability arguments. The key financial inflection point is unsupervised operation. Tesla recently achieved a major milestone in Q3 2025 with FSD V13, which attained 1.5 million miles per critical intervention, a safety metric the company says surpasses the average human driver benchmark. This prompted the beginning of unsupervised robotaxi testing in Austin, Texas, in December 2025. However, this progress is met with regulatory friction. The California DMZ, a key autonomous vehicle testing jurisdiction, recently denied Tesla's application for unsupervised permits due to concerns over insufficient safety data and persistent intervention rates. Central to the robotaxi narrative is the Cybercab, a dedicated 2-passenger autonomous vehicle revealed with no steering wheel or pedals. CEO Elon Musk has set a highly ambitious timeline, stating production is slated to begin in April 2026 at Giga Texas. The financial pitch is a target price under $30,000, with an operating cost of about 20 cents a mile. However, a Forrester analyst, Paul Miller, quickly expressed skepticism about this price point, calling a launch at anything close to that figure not plausible without significant subsidies. Skeptics argue the market has prematurely priced in perfection. Morgan Stanley, for instance, downgraded the stock, noting that its valuation, which trades at a forward PE multiple over 190x, already presumes a perfect robotaxi future. Furthermore, the unique Shepherd business model, where individual owners operate their own fleets, is criticized by industry leaders. Edwin Olson, CEO of May Mobility, noted this model doesn't make a whole lot of sense for a cash-printing machine technology that should attract institutional finance. On the bullish side, the argument centers not on automotive manufacturing, but on AI capability. Tesla increased its AI training compute capacity by 400% in 2024, giving it a powerful data-driven learning loop. Bulls point to the vast FSD consumer fleet as a unique data advantage. Kathy Wood's ARK Invest maintains one of the most optimistic positions, expecting that robotaxis will account for 88% of the company's enterprise value by 2029. For these investors, the data science is the moat, and the technological leap is inevitable. The market is increasingly bifurcated. Waymo and other geo-fenced operators are executing a stable, controlled scale-up with thousands of robotaxis. Tesla's strategy, by contrast, is a high-risk, high-reward bet on general AI. Sentiment, despite skepticism regarding timelines, with CFRA analyst Garrett Nelson saying he expects Musk to overpromise on robotaxi timing, is currently dominated by the massive upside potential. The stock's performance near record levels at year-end 2025 reflects investor belief in the AI narrative, not the current production reality. For investors, the next 12 to 18 months represent a critical prove-it period. There are two primary metrics to monitor. First, the regulatory expansion of unsupervised FSD outside of pilot zones like Austin. Second, the successful volume ramp of Cybercab production, which is scheduled to start in Q2 2026. For investors, the next 12 to 18 months represent a critical prove-it period. There are two primary metrics to monitor. First, the regulatory expansion of unsupervised FSD outside of pilot zones like Austin. Second, the successful volume ramp of Cybercab production, which is scheduled to start in Q2 2026. A failure to meet the April 2026 production target or further regulatory blockades in key states like California would likely lead to a painful re-rating of the stock's future value, moving the narrative definitively toward the skeptics. Let me know what's your thoughts and leave your comments. Thank you for joining us for this crucial deep dive. To ensure you never miss a pivotal analysis, please like the video, subscribe to the Tesla Deep Dives channel, and hit the notification bell. Your engagement fuels our critical research.